What's up, y'all? Welcome back to another video. Today's video is going to be about how I would invest my first $1,000 in 2026. So if you're just sitting, this works for 10,000, 20,000, 30,000, but I'm going to start with the 1,000 because that's pretty much the basic amount of money like anybody will probably have. Especially if you're watching this and you're probably like 19, 20. So how to invest your first $1,000. So if you have $1,000 and you want to invest it, but you're not sure exactly where to start, should you buy crypto? Should you get into stocks? You've heard about ETFs. What should you do with that money? Should you start a Roth IRA account? Should you invest in NFTs? There's NFTs. I don't know if any of y'all remember, but when NFTs came out, everybody was trying to get into NFTs, but that's not really like a good investment strategy. So I'm going to be telling you and explaining to you the different routes you should go and what you can actually do with that money, right? By the end, you'll understand where to start and why you're even starting where you're starting. Like if you're going to go the Roth IRA route, if you're going to open up a personal brokerage account and you're going to invest into some ETFs, if you're going to pick some single stocks, what exactly that you want to do to start and build a portfolio to start and with your investing journey. The first thing I'd probably do if I had $1,000 is understand what ETFs are, right? And invest into ETFs and index funds. Why? First of all, what is an ETF? So, just a general note, ETF. What is an ETF? An ETF is an exchange traded fund. It's a type of investment fund that holds a basket of stocks, right? It holds a basket of stocks, different bonds or commodities. Depending on which ETF you pick, those are the type of securities you will be investing into, depending on which ETF you pick, right? And it trades on the public stock exchange just like any individual stock. Just so the same way you hear about Apple, Tesla, Nvidia, these different companies, Broadcom, there's more out there, Microsoft, Google, those different types of companies, you can invest into them individually. But what an ETF does, depending on what the type of ETF that you use and pick, you can invest into all those companies into one, right? So you don't have to just pick Google. You don't have to just pick Apple. You don't have to just pick Tesla. But depending on the ETF that you're using, whether it's VOO or SPY, all these ETFs could have a basket of these stocks, could have a basket of Apple, Nvidia, Meta, Microsoft. It'll have it in this one ETF, and then you'll just put your money into there and it will grow over time. That's what I'm saying. The ETF is the safest route to go. So if you had this amount of money, you had $1,000, your first bet is to probably take 500, 600 of that money and start it off in ETFs. ETFs are diversified, right? Meaning they don't give you too much exposure into just one sector. They don't give you too much exposure into just one stock, right? So if you're using an ETF like VOO, it has some holdings like Nvidia, Apple. You're having a little bit of every company. So you're not getting too much exposure of Nvidia, you're not getting too much exposure in Apple, you're not getting too much exposure in Microsoft. Obviously it holds the top 500 companies in the world, right? That's how it's weighted, but you're getting a little bit of exposure from every different stock that's in that ETF. They're diversified, so your money spreads around many companies. They have low fees, right? I'm pretty sure for VOO it's like probably 0.030. So every amount of money that you like, the yearly expense ratio is 0.030. Yeah, if I'm not mistaken, 0.030. So it's 3%. That's the yearly expense. So it's not that much. They're not taking as much back from you as other ETFs would probably take from you. So just to name a few, VOO is the top 500 companies. QQQ is the technology sector. It's a technology ETF that you can put your money into, and it will invest into different technology companies, right? So I would take $500, $600 and invest it into the S&P 500, which is an ETF that tracks the S&P 500 index, right? An S&P 500 ETF that tracks the index, and over time it grows, because this is one of the safest routes that people go, because naturally the top 500 companies in this ETF will grow over time. And what they do is these management companies that manage these ETFs, they naturally cycle out the bad companies that are not performing for the year. So this ETF or this index that you're going to be investing into, it will always be growing because the top 500 companies will be in there. Not just the top 500 companies. Let's say it's top 500 companies, but then 100 of those companies start underperforming. It doesn't just stay with those 100 companies that are underperforming. It's always rebalancing. It's always readjusting. These managers and management over these portfolios are consistently taking out some of these companies that are underperforming and adding new ones that start performing well and that meet some of the criterias that will allow them to be in the S&P 500. All right, so 500 or 600. So now you're left with probably 400, 500, depending on which one you want or which amount you choose. So that's how much I would start with. 500, go to ETFs, start maybe 400 with VOO and then 100 with QQQ. You don't want too much exposure with technology because right now we're in a technology boom. But one thing you got to be wary of is we're in a technology boom because of AI, but AI is a very risky thing, right? AI and technology right now are very risky. I know everybody's talking about it, everybody's hyping it up, but all of a sudden this ETF can go down. It won't matter as much because it won't make too much of a dent on your portfolio, but you have to understand the risk that comes with investing into an ETF like QQQ. So you have 500, 600, you invest into ETFs. That's where you start off with. The second is investing into yourself, investing in your skills, taking courses, buying different books, learn a skill that increases your income. I want to take some time to talk a little bit about taking a course, right? You could take a course to do anything. Learn how to start doing people's taxes, learn how to become a bookkeeper, learn how to start copywriting. There's multiple courses you could take on different things. And then once you have those skills, you can create a business and scale off of that. So that's one thing you have to learn how to do is invest into yourself, right? Buy a book. My goal for this year is to read a book every month. January, I did it. I completed the amount of books I was going to read. Well, I read one in January, but it's February right now. And you have to try to, for me, I'm struggling throughout this whole month to read that book. But one of the things that I've understood is that you have to try and make a sacrifice, right? To be more intentional with, if you're going to buy a book, trying to read at least 5 to 10 pages every day. And obviously, don't think you're going to read 30 pages, 40 pages, 50 pages straight. If you can do that, that's good for you. I'm not someone that could do that anymore because we have a lot of stuff that I'm doing. So if you're someone that can take the time to read a book for 30 minutes to an hour, read 30, 40 pages in a day, that's good. But I'd like to hit milestones like 10 pages a day. And then by the time the end of the month comes, I know I'm done. I've been struggling low key with this month and reading books because I've been so busy, but try something new, right? Invest into yourself, invest into your knowledge, because knowledge is wealth, right? It's not only the money that you're making, but it's also what you're putting into your brain that's going to help you understand more. That's going to help you understand the world better. It's going to help you understand the market better. It's going to help you understand people, right? It's going to help you understand society, what's around you, your environment. So just reading psychological books, reading history books, reading personal development books, all those types of books are going to help you become a better person. I don't mean to go on a motivational rant about personal development, but personal development is one of the best ways to invest, right? You have to invest in the type of person you are, who you are, because you don't want to stay the same every year that comes, right? You want to grow as a person. You want to grow your mindset. You want to grow how you think, how you talk, the way people see you, because whatever you're putting out there is what people look at you as. So when people see you and you're talking a certain type of way, that's how they read you, and that's how they reciprocate their energy back towards you. That's how they respond to you. So reading is a smart investment. Reading books that will help you become a better person mentally, right? And think on a different level, be able to speak better, be able to form coherent sentences where people are able to translate what you're saying and actually understand it, is a big investment that I think everybody at whatever age you're at should be making. So my goal is a book a month. That's my goal. I buy a book a month and I just read it, whether it's a finance book, personal development book, or a history book, or any type of book that you find interesting, or you topics that you might find interesting in the moment. So taking a course, buying a book, learning a skill that increases your income. That goes back to taking a course. Whatever course you're taking, make sure it's like a skill you're being taught. So once you're done learning that skill, you can expand on that and you could potentially start a business with whatever skill it is that you took, whatever course it is that you took. Then the third investment that I would probably make is into shares of different companies, right? In the beginning half of this video, we talked a little bit about ETFs and what they are. ETFs are a basket of stocks piled into basically one stock, and you could buy it. You don't have to wait. It's traded on the stock market. People trade it. People trade SPY. People trade QQQ. So these are things that people actively trade, and you could buy in, buy out at any moment. But the goal with an ETF is to think more long term. But this third option with buying fractional shares of different companies is also important too, right? You take $100, $200, $300, however much is left from that initial $600 or $500 you put towards your ETF and then towards your courses and skills that you went out to learn. But then the rest of the money, you can invest it into fractional shares. You can invest it into individual companies that you've done your research on, right? This is kind of like the fun part, right? I don't want to say it's a fun part, but it's the part where you can just go out and do a little bit more research, and it's a little bit high risk, but also high reward if you know what you're doing. That's why I say go do your research first. Go understand the type of companies that you might want to invest into. Go understand the type of individual stocks that you might want to get into. It's not all about, oh, I'm going to just invest into this company because I like them, right? You're not just going to invest into McDonald's because you like them. You have to understand what's behind the company. Do they pay dividends? Is that why you're investing into them? Are you looking at this company as more long term? Why you're investing into this company? The reason why? Like, I made a few mistakes investing into a few companies that I didn't totally understand, right? Everybody will make mistakes, but it's how you learn from them and what you do with those mistakes, right? Do you take those mistakes and you pile them up, or do you learn them? Because we're all, in our lifetime, we're going to make expensive mistakes. That's part of the game, especially investing into stocks and high risk plays, right? That's part of the game. So this is kind of the fun part where you just go out, do a little bit of research, invest into, my advice would be invest into the top tech companies, right? Although AI is booming right now, but there's some downturns in dollar cost averaging, which means every time stocks are going 5, 10, 15, 20% down, like these tech stocks, you're adding to your positions. That means you're consistently paying and spending money, dollar cost averaging. You're going into these, putting 300, 200 every time the stock comes down 5, 10%, because ultimately you have, your time horizon is more long term than short term. You're looking at it from a long point of view and not just what is the price now. Oh, and you're being manipulated by the fluctuations in the daily market. You shouldn't be looking at that. If your time horizon is 5 to 10 years, daily fluctuations shouldn't matter to you. The only reason you should be looking at daily fluctuations and like the market going up, volatility and all of that, is if you want to find buying opportunities. That's the only reason you should be looking at it. You shouldn't be looking to see, oh my God, if it's going up, should I invest? Should I take my money out? That's not how investing works, right? You want to build your positions out, dollar cost average into your positions, and allow time to do its thing, allow time to do its job, right? Small risk. This is a small risk, but you have potential to learn big. You have potential to learn big, especially with the small amount of money that you're putting in, because majority of your money is going to be to your ETFs. That's what balances out your portfolio. But the second half of it is the individual stocks. This is kind of like the experimental phase of it, where you're just experimenting, seeing what stocks you can choose, what stocks to not choose, doing a little bit of research here and there, right? Example is like Fractional shares are like a company that you believe in strongly, like Nvidia, AMD, Google. If you believe into these companies, if you believe in what they're doing, if you believe in tech, and you believe that tech and AI are the future for tomorrow, then you should be investing into these companies. Every time these companies fall 5, 10, 15%, you should be investing into them. That's the main thing. And then the last thing I would say to do if you had $1,000 is to keep some for cash, right? Have an emergency savings fund where you're consistently saving and putting aside, whether it's for projects, whatever it's for. But this cash that you're saving has to go into a high yield savings account. It can't just go into a regular checkings or savings account like a Bank of America, because your interest rate, you're not getting too much in return back, right? Your Chases, your Bank of Americas, your Wells Fargo, they do not give you interest back on this money. Or if they do, it's 0.01%. They're not giving you too much back for keeping your money saved up in their bank. But if you choose a bank like SoFi, these online banks, these fintech banks, SoFi, Vero, there's a few others out there that if you use them, then you could get some good returns back on the high yield savings account, like a 3.40 APY, right? APY just means annual percentage yield per year. So think about that. The extra money that you're having, save that for whatever projects that you might have. If you want to save up for a car, if you want to save up for a vacation, right? Or if you just need excess money on the side, because you never want to invest money that you might need immediately, because you don't want to be building your portfolio and then have one day to be like, okay, I think I need to take some of this out because I have a project. So you always have to have some cash and some money on the side, right? Because emergencies happen, life happens, your car could break down, someone in your family could get sick. Life just happens. Like, things will just happen over time. But having that emergency savings fund, it will keep your investment safe and keep you from selling anything that you don't have to sell, selling your investments. So these are the main things that I want you to focus on. And last but not least, is I just want you to automate and track everything, right? You have to automate your investments. You have to automate your saving. So all these things have to be automatic. You shouldn't be having to, like, okay, think about this too much, think about this too much. If your paycheck is 700, you should already have that budgeted out. Okay, I'm gonna take 100, 200 out for bills for this month, and now I'm all good. Then you budget out the rest on your investments, your emergency saving funds, whatever book you want to buy, a course that you want to spend money on, and then that's how you could actually build some type of wealth. That's how you will build out your whole portfolio. And with those like secrets and with these things that I just told you, you can actually use that $1,000 to start building something and build momentum, because you're not only going to make 1,000, that's to start off, but with the rest of the money that you're making from working, whatever it is, you can actually take more of this money and add it. And that's how you can grow your money. That's how you can compound your money over time. So there it is. ETFs, index funds, investing into yourself, right? Taking a few small bets here and there with a few stocks, which are not really bets, because once you start understanding how it works and how the market works, then you realize, okay, I'm not making bets. I'm not making risky bets. I'm actually making calculated risk. Then your emergency savings fund, and then automating and tracking everything, right? This is exactly how I'd invest my first $1,000 if I was starting today. Simple, beginner friendly, and pretty much easy for anybody that's out there, right? If you found this video informative and something that you like and you feel like this helped you, then please like, comment, subscribe, and let me know what you guys think. Peace.